we launched our Telegram group for students. There we will share the study materials and sessions. Also, students can ask questions directly to me and with our digital accounting team also. And next important one is we are requesting our students and our well-wishers to support by sharing our video lessons, and if you think it will helpful to get success in the upcoming and also other exams of the students. And also we have arranged special individual student class programs for students who actually in more need. For further details you can join our Telegram group and contact the admin or me there, and we will share the further information about this online individual program. Okay, thanks. Let's get into the session. Let's continue with the question number 31. Which of the following stakeholders of a business entity would be the most interested in each of the information given below? So they have given 4 stakeholders: government, investors, lenders and managers. And they asked to indicate the number. So they asked to indicate the number. So don't write the letters, so it will waste your time. The A, the entity's ability to meet its long-term obligations. The B, the profitability of the entity compared to the capital invested. C, the cost of products manufactured by the entity. And D, the amount of taxes paid by the entity. Okay, so for this question, stakeholders and interested informations. So you need to know interested stakeholders. In your syllabus, you need to know the 6 stakeholders types and the information requirements of the stakeholder. In this type of question, don't think much. Yes, just think, if you are the interested stakeholders, so what are the information you will ask from the particular entity? So owners, we can say in the other terms, investors. So if you are an investor, you will expect a profit because you have invested in that company or business, so you will expect a profit, so satisfactory profit. And the second one, if you invested in that company, if that company runs with the profits only, you will further invest in that one. So you will think about should further investments be made. So further investment decisions informations, and you will need a satisfactory profit. And if you are a management, so management in the sense it will be a top management or middle level management. So management means that's an internal part of the organization. So they will think about their plans implemented appropriately. So the top management implement the plans, and the middle level managers and the first line managers are implementing, and it is practically applicable. So they will think about that one. And what are the necessary plans or decision for the future development? So how that company can be developed in future. So these type of internal decision makings managers will, and employees. So if you are an employee, you will expect your job security. Is it stability? Is there any chance to increase your wages or salary? If you are an employee, you will consider these type of information. And government institution like a tax department, if you are a government institution, you will think about how many tax you can collect from that particular entities. Are they fulfilling the due dates, deadlines of the tax filings? Are relevant reports submitted to appropriate entities? And also, are quality goods available at a reasonable price? As a government, you need to think about the public also. So you will think in that form. And customers, as a customers, we will think about the quality of the goods they are providing. And also if that organization has a reputation in the society. And creditors and lending institution means who has given finance to the company. Then they will think about whether I can recover that money from that particular entity. And also, is it feasible to extend the credit facilities? They have already given a facility, they have already given credit facilities. Is it possible to give further them? Are they profitable? So these kind of informations those stakeholders needs. According to the type of stakeholders, the information will be different. This is very simple. Okay. The entity's ability to meet its long-term obligation. So long-term obligation means more than 1 year. So who need that information, whether that entity is in the ability to pay the long-term loans? So obviously the person who has given the money to the entities. So that name, the technical name is lenders or payables or creditors. Here we have given the name by lenders. So the third one. B, the profitability of the entity compared to the capital invested. So profitability of the entity compared to capital invested, that's the owners. In other words, we can call them as a investor. The second one. The third, the C, the cost of products manufactured by the entity.
So the cost of products, the pricing systems, those are the internal parts. Managers will be need those information to take the decision. And D, the amount of taxes paid by the entity. Obviously, that's the government. 3241. We will continue with the question number 32. So which of the following statements indicate the impact of each of the above transactions? So for this type of question, you need to produce a double entry quickly and see whether it's assets or liabilities or equity, so in which it's affecting. So the first one is received cash rupees 500,000 by issuing ordinary shares. So debit record will be cash 500,000 and the credit record, it will go to stated capital. So this section is increasing in the cash. So increasing cash means assets. Stated capital means equity. So increasing in asset and increasing in equity. That's a category C, the first one. The second one, purchase goods for rupees 1 million on credit. So purchasing goods means that's an inventory. So 1 million we are purchasing, and the credit entry will be on creditors. So here the inventory, the asset is increasing, and also the creditors, the liability is increasing. So increase in liability and also increase in asset. That's a category D for the second one. The third one is revalued the land for the first time, which resulted in a deficit of rupees 300,000. So the revaluation, the first time revaluation, second time revaluation session in the previous session number 3. So if you want, you can look at that one. So revalued the land of the first time, we will record that as an expense. So as an other expenses. The credit entry will be that's in land, the particular asset. So here other expenses is increasing. It means expense increasing mean the profit will be reducing. Profit is reducing means we are going to reduce the retained earnings. So retained earnings is reducing, so the equity is reducing. Simply expense is reducing means we are reducing the equity. The land, the asset is reducing, and also our equity is reducing. Then the fourth one, incurred advertising expense of rupees 60,000 and it is payable in May 2018. So the debit record will be advertising expense, that's 60,000. The credit record will be in payable, because that's going to pay in the May for the 31st March, that's a payable 60,000. So increase in expenses, so reducing the equity, and the payable also increasing. So the category is increase in liability, at the same time reducing the equity, the second category. So that's the answer for 32. So let's look at the question number 33. State the prime entry book in which each of the above transactions are recorded. So we have 4 transactions here, and we need to look at the which prime entry. It means very first time where we will record these transactions. So for this one you need a knowledge of prime entry books. What are the prime entry books we have? So here 8 prime books of prime entries are there in your syllabuses. So you need to know in which cases we need to record in which books of prime entry. In the first one, if we are receiving in a cash, something we are receiving in the form of cash, so that's a cash receipts. So we need to record in the cash receipt journal. In previous syllabuses we can say just a cash book, but nowadays we are dividing that cash book, prime entry book in 2 categories. That's a cash receipt. It means our debit side of the cash book, cash receipt journal, and credit side of the cash book we are calling as cash payments journal. Now in the new syllabus the concept is we are calling as a separate books of prime entry. So cash transactions, if we are receiving cash receipts, we need to record in the cash receipts journal, and we are paying in a cash, we need to record in the cash payments journal. The third type of books of prime entry, if we have a purchase invoices, it means credits purchases, we need to record in the purchase journals, and credit sale we need to record in sales journal. And if we have a sales return, purchase returns, it means sales returns journals and purchase returns journals. Petty cash vouchers, any petty cash payments we need to record in the petty cash payment journal. If we don't have any above, so we need to record in the general journal. So you need to look at the transactions whether we are receiving anything in the cash form, so that's a cash receipt. Are we paying anything in the form of cash, so cash payment journals. If we have a credit sales, that's come under the, if we have a credit sales we will record under the sales journal. If we have any credit purchases we will record into the purchase journal. If we have any purchase returns journal. If we have any sales returns journals. And other one, the final one is we need to look at if it's anything petty cash payments. So we need to record into the petty cash payments journal. We don't have any above categories, so we need to look at the general journal and we need to record in the general journals. So that's a theory. So look at the question. In the first question, we have received a cash for our ordinary share capital issue of 500,000. So we have received a cash, so we need to record that into the journal related with that one is cash receipt journal, because we received cash receipt journal. And the second one is the inventory. We have purchased goods 1 million rupees of, so we have purchased goods for credit, so that's a credit purchase. So credit purchase means purchase journal. The third one, we have a first time deficit of rupees 300,000, so that's an other expenses. So we don't have any cash receipt here, any cash payment, we don't have any credit purchases or credit sales, no sales returns, no purchase returns, and also this is not a petty cash payment. So we have an option to record under the general journal. So this is how you need to determine the general journal. And the fourth transaction is advertising expenses. There is no involvement of cash here, same as no sales, no purchase, no sales returns, no purchase returns, no petty cash voucher. So general journal. So that's the answer for question number 33. So let's continue with the question number 34. So indicate with the tick the types of account under which each of the above transactions is recorded in the general ledger. The first, which account type it's going to affect. So if you see, the first one is the ordinary share capital issue. The first one is cash, so asset is going to increase. So you need to tick that one. For your understanding, I will type the letters. And stated ordinary capital, that's an equity one, so you need to tick on both accounts, stated capital and cash account. And the second one we can say inventory, that's an asset. Then creditors, that's a liability account. And the third one, other expenses, that's an expense one. And land is an asset. Then advertising expenses, that's an expense. And the payable is a creditors. For the second one, it means the purchase of goods. If you see the marking scheme, they have given the marks if the student tick the expenses category also, because sometime we can tell the journal entry as a debit record in purchase account and credit in creditors account. Sometime we can consider that also. They have considered purchase as an expense and they have given the marks to tick for liabilities and expenses, but in fact, so these are the original answers. So this is the answer for question number 34. So question number 35. Use the following information to answer question number 35 and 36. So two questions are related with that one. The following information relates to Amal PLC asset 1st April 2017. So the opening balances is given in rupees thousands. Trade receivables 900, allowance for doubtful debts 90. The following transactions were carried out in the entity during the year ending 31st March 2018. So during the year transactions also has given. Credit sales 3600, sales return 400, receipt of cash for trade receivables 2800, bad debts return of 200. The business makes a 10% allowance for doubtful debts on the year end balance of trade receivables. The question number 35 is asking the following as at 31st March 2018. At the year end trade receivables control account balance, carrying amount of trade receivables reported. And the question number 36. Journal entries to record the bad debts and doubtful debts for the year ending 31st March 2018. So before attempting to this question, we will look at the theory. We will revise a little bit of theory behind this one. So it will make sense to the why behind every questions. Why we need to do this one. Why we need to do this double entry. So it will make more sense if the question get complex. So we will look at the prudence concept here. So what it means by prudence concept and how it impact the provision for doubtful debts and bad debts accounts. So prudence concept means do not overestimate the amount of revenues recognized or underestimate the amount of expenses. What it means by is, so just for example, if you have a business and if there is a possibility to make a sale in future months, the prudence concept is saying don't recognize future revenues in the current month, because don't overestimate the amount of revenues recognized. That's the theory. Then the second one, don't underestimate the amount of expenses. Just say in the future month you are going to have an expenses, The prudence concept is saying if you are sure with you are going to make an expenses, so don't underestimate the amount of expenses. It means don't overestimate the amount of revenues recognized or underestimate the amount of expenses. Also, one should be conservative in recording the amount of assets. It means record the actual amount of assets and not underestimate liabilities. So that's what we are reducing the receivable amount by providing provision for doubtful debts, and we are reducing our actual asset value by giving depreciation, and we are recording the inventory in the lower of NRV, net realizable value, or cost. So why we are conservative in recording the amount of assets and not underestimate the liabilities. So this is a concept called prudence concept. Then this prudence concept in your exam, if the examiner is asking about examples of prudence concept, you can say provision for doubtful debts. Because why we are having a provision for doubtful debts accounts, we are going to reduce our receivables by this amount, because we are not going to overestimate our assets, because these part of the assets we can't recover from the receivables, so we can't overestimate our assets. So prudence concept. And provision for depreciation, why we are doing a provision for depreciation, we can't overestimate our assets because assets values are reducing, so we need to provide a provision. So that is also prudence concept. Recording inventory, why it's prudence concept is the LKS2 inventory standard is saying we need to record the inventory the lower of NRV or cost. Because of why we need to give the actual amount, we can't overestimate the amount of assets we have. So that's the theory behind that one. And most of the students having confusion between bad debt and doubtful debt. Those are different type of accounts and different type of treatment. So you need to understand clearly the difference between bad debt and doubtful debt. A bad debt is an account receivable that has been clearly identified as not being collectible. Clear evidence should be there. So it means, so if you have 100,000 amount of receivable and you are sure 10,000 you can't recover from a particular person, or you can't recover 10,000 from your previous experience, or you got a mail from a particular customer, so you know very clearly you are not going to collect that 10,000. So that's a bad debt. You have a clear evidence, you need to write off that one. That's called bad debt. There is no doubt on that one. We have a clear evidence. What do you mean by doubtful debt? So doubtful debt is an account receivable that might become a bad debt at some point in the future. So you have only a doubt. For an example, you have 100,000 amount of total receivables. From that 10,000, you have a doubt on a particular customer whether he is going to pay or not. There are some symptoms he is going to bankrupt. So that's only a doubt. That's called doubtful debt. So bad debts, we have a clear evidence, we are not able to collect. Doubtful debt, we have only a doubt. We don't have any evidence to tell that's a bad debt. So these are two different debt. These are two different accounting scenarios. So we need to treat them differently. What are the double entries for the bad debts? So bad debt, we have a clear evidence. So first what we have to do is, that's an expense. We need to expense that one. Charge as an expense to P&L according to prudence concept as a bad debt account. And we need to credit the receivable or debtors control account to reduce the amount of receivable asset according to prudence concept. Because of why we can't collect that amount from receivable, and also according to prudence concept we can't overestimate our receivable asset. So we need to give actually how much we can collect from customers. So we are reducing receivables control account. So let's look at the double entries for doubtful debts. So doubtful debt, we have only just a doubt. So we need to ensure whether this doubtful debt we are going to record at the first time or the second time. If it is a first time, you need to record as an expense according to the prudence concept as a doubtful debt expense in the P&L, and you need to create a provision for doubtful debt account or allowance for doubtful debt account to reduce the amount of receivable. And if it is a second time and also it's increased, the provision for doubtful account balance is increased, you need to check in every questions whether they have given a opening balance for doubtful debt account, opening balance for allowance for doubtful account. So if it is any opening balance for allowance for doubtful debt account, you need to record only for the increase or decrease between the opening balance and closing balance. So debit record in the doubtful debt, closing provision, take away opening provision amount. Then you need to make a debit record only for that particular change between the opening balance and closing balance of the allowance account, and credit the provision for doubtful debt or allowance for doubtful debt. So closing provision, take away opening provision. If the second time is a decrease, you need to reverse the above g.c.e. So you need to record the debit record in the provision for doubtful debt account and credit in the doubtful debt. It means other income. So let's look at the question and do the, once we have done the question, you will have a more understanding about this theory. Okay. So in this question, receivables control account balance. So you can do this with the T entries or T account also. So this time I will going to do this question as a statement form. Opening balance. So we have a opening balance of trade receivable is 900, and also we have a allowance for doubtful debts account also opening balance. And the following transactions were carried out in the entity during the year ending 31st March 2018. So credit sales. If we make a credit sales, so the double entry will be debit record in the receivables and also credit in sales. So the credit sales is a total credit sales. So the credit sales will be, it will increase the trade receivable balance by 400. Then we have a receipt of cash for trade receivables. So if we receive the balance amount from trade receivables, it will reduce the receivables account. So receipt of cash 2800. So we have given with trade receivables opening balance. Opening balance is 900. Allowance for doubtful debts, that's an opening. So we need to remember we can only record for increase or decrease between opening and closing balance of allowance for doubtful debts, not here. And credit sales, so credit sales will increase the trade receivables. Then we have a sales return. So sales return, it will reduce the trade receivables balance 400. And receipt of cash for trade receivables 2800. It also will reduce the trade receivable balance. And bad debts written off 200. You need to remember what's the double entry for bad debts written off. So bad debt we need to recognize as an expense, and also immediately we can reduce our receivables control account balance. So 200 we can reduce directly. So the business makes a 10% allowance for doubtful debts on the year end balance of trade receivables. So these are the only things affect the control accounts. So students need to have a clear allowance for doubtful debts. If it is a first time, we need to record doubtful debt as an expense, so it will go to the P&L, and we need to record under allowance for doubtful debts account. There is no entry in the trade receivables control account or trade receivables account, but bad debts we have a direct entry to reduce the trade receivables control account balance. And we know if we have a allowance for doubtful debts opening balance, we need to record only for increase or decrease for that allowance for doubtful debts account. So the control account balance is total trade receivables control account balance is 1100. And the part B of the question is asking carrying amount of trade receivables reported. So here what it means by reported, it means finally which amount will go to balance sheet as a receivables. So what it means is after we deduct the allowance for doubtful debts. So this is trade receivables as at 31st March 2018. So you have 1100 trade receivables and you need to less the allowance for trade receivables 31st March 2018. So in 31st March 2018, what's the balance of allowance for doubtful debts? So how can we determine is opening balance is 90. They have set in the question the business makes a 10% allowance for doubtful debts on the year end balance of trade receivables. So we know now the year end balance is 1100. Then you need to take a 10 percentage of 1100, so reduce the 10, so 110. So 110 you need to deduct. So 110, if you deduct that one, 990 will be here. So 990 will be the answer for carrying amount of the trade receivables reported. And the question number 36 is asking journal entries to record the bad debt and doubtful debts for the year ending 31st March 2018. So first, for the bad debt, we need to expense that bad debt amount. So the amount of the bad debt is 200. Then the credit record is directly to trade receivables control account. Then the B, the doubtful debt. So debit the doubtful debt. You need to make sure you are going to record only for the increase or decrease for the opening, decrease for the allowance for doubtful debt account. So you know the closing is now 110. How you have calculated is 1100 times by 10 percentage. So 10 percentage of 1100, 110, because the business makes a 10 percentage allowance for doubtful debts on the year end balance of trade receivables. That is the closing amount of doubtful debt. That's a closing amount of provision for doubtful debt. So 110. The opening has been given as a 90. So the increase is 20. And you need to credit provision for doubtful account as 20. So this is the answer for question number 35 and 36. So let's do the question number 37. The following transactions took place in Ishiru's catering business. So it's a kind of food service business. So in January 15, 2018, accepted an order to supply food and received a cash advance of rupees 100,000. May 28, 2018, supplied the food for the above order and received rupees 200,000 in cash. And February 25, received the balance amount of rupees 50,000 for this order. In relation to recognition of revenue of the above order, date of recognition of revenue and revenue to be recognized on this date and the most applicable accounting concept. So this is a simple question. So here you need to understand when we need to recognize a revenue and also what are the criteria it should be met. So the first transaction will be January 15. So what's happening in January 15 is accepted an order to supply food and received a cash advance of rupees 100,000. So what we will do is we will debit the cash because we received a cash of 100,000. And after that, the credit record, we have received an advance for what? For the future sale. So that we can't recognize that as a revenue because we didn't perform the service or we didn't deliver the goods now. So we will credit to the unearned income or deferred revenue. It means the revenue earned is deferred. So until we deliver the goods or until we perform the services, that is a liability for us. So deferred revenue, that's not a revenue actually. So we can't recognize on January 15, we can't recognize the revenue because if we want to recognize the revenue, we need to perform the obligations, or otherwise in other words, if it is a goods, we need to deliver that goods. We need to transfer that risk and rewards of the goods to the customer. If it is a service, the service should be performed. That time only we can recognize the revenue because we earned that income. So now we just only got an advance. We didn't supply the food. So then January 28. So what will happen in the January 28? Supplied the food for the above order and received rupees 200,000 in cash. So here you need to understand the words correctly. Supplied the food for the above order. It means we have delivered our goods. So we have performed our obligations. Now the risk and rewards are with the customer. And also we received a 200,000 in a cash. Before we have received 100,000. Now we have received 200,000. So both are now we can recognize as a revenue. And if you look at the third point, February 5th, received the balance amount of rupees 50,000 for this order. So here the words the examiner used is receive the balance amount. So balance amount means it's already there. That's why he's saying the balance amount. So 100,000 is an advance we have received, 200,000 as a cash when we delivered, and the remaining one 50,000. So how much worth of food we have delivered is 350,000. So here actually, for your more understanding, we have received a cash. We have received a cash of 200,000. So in that point, we can record 200,000 as a cash. We have delivered 350,000 of foods. So here we can recognize revenue for 200,000 also. And also at the same time, for this 100,000 also now we can recognize as a revenue because we have performed our service. So January 15 we have recorded as a deferred revenue. So now the journal entry will be, we will reduce the liability account of deferred revenue, debit record. So deferred revenue of 100,000 we will reduce, and the credit revenue, and we will credit to the revenue. And also in January 28 we should know the worth of goods we are delivering is 50,000, and also we should receive that in future. So if we receive that, the receivable, so the receivable amount is 50,000 for the third point, and we will credit to the revenue because in that point we know the worth of delivery we have made is 350,000. Then again February 5th, what's happening is we receive the balance amount of rupees 50,000 for this order. So now you need to do is, so we have received a cash of 50,000. We need to deduct the receivable 50,000. So now you can understand each point what are the double entries is going to be. Now what's the date of recognition? The date of recognition is obviously January 28. So that's the date we have delivered our food. It means we have transferred the risk and rewards of the goods to the customers. It will be January 28. And the second answer, revenue to be recognized on this date. So this date we have delivered the worth of goods is 350,000. 100,000 we have received advance, then 200,000 we have received at the time of delivery, remaining is 50,000. So the actual revenue we have earned it is 350,000. Then the most applicable accounting concept, the accounting concept is revenue recognition concept. It's called revenue recognition concept, or we can say realization concept. So let's look at the question number 38. So indicate how the adjustment of following items in the financial statements of a public limited company will lead to increase, decrease, or no change in its profit. These items are noted adjusted in the books. A, B, C, D. So there are 4 items. So we need to indicate as I, D, O, N, C. So increase, decrease, or. So before attempting to this question, so I need to clear 2 points. So what's the relationship between expenses and profit, and what's the relationship between income and profit? So here expenses increase, profit decrease. Expenses decrease, profit increase. So this is the relationship between expenses and profit. And if you see the income increases, profit increases. Income decreases, profit decreases. So this is the basic concept of expenses. This is the basic concept of relationship between expenses and profit, and income and profit. So here there are 4 types of transactions they have given. So these 4 types of transactions, how the impact of the profit will be. So there might be increase or decrease or no change. So we need to mention that one. For a better understanding, we will look at the double entries of each. So A. So here accrued electricity. So what it means by accrued electricity, we need to pay electricity. It means actually we have received the electricity bill but we didn't pay it. So it already incurred. So the expenses incurred. It's like normally in our day-to-day life, if we have a February month bill, we will receive in the March. That February we have already utilized that electricity. So it already incurred that expense. We need to record for that expenses. So anyhow it incurred, that's an electricity expense. We need to charge to the P&L electricity expense. Then the credit entry will be electricity payable. So now you need to determine what are the categories it's related to. So electricity, that's an expense type. So here electricity is increasing. Electricity payable is a liability. Liability also increasing. So the B, interest income receivable. So interest income receivable account. Already earned that income but not yet received. So that's an interest income receivable. And credit, we have earned that income, so it should be interest income. So interest income receivable is an asset because we have earned that income but not yet received. So like receivable, this is an interest income receivable. That's an asset account. Interest income, we have earned that revenue, that's an. And the C, discount received from creditors. So discounts, that's an income. And from creditors, so we don't need to pay. Look, for an example, you need to pay 100,000, but the creditor said you don't need to pay 100,000, pay a full amount of 70,000 and I will deduct the 30,000 from your balance. So you paid 70,000, then the credit balance is 100,000 is going to reduce. So you need to deduct the discount received account from your creditors because you are not going to pay that one because you received as a discount. So we don't need to pay that amount. So discount received, we need to reduce the creditors. Reduce the creditors means debit record in the creditors account. And discount received is an income account, increasing income, crediting the interest income account, crediting the discount received account. So creditors is a liability is decreasing here, discount received is income. You can say expense here, income here, income here. And the D1 is surplus on revaluation of a land for the first time. So first time revaluation, what we have to do, and we have discussed the question in the session number 3, so you can visit there. So what is about this first time revaluation? So surplus on revaluation of a land for the first time. So first time revaluation, we need to increase the asset land. And revaluation surplus, that's an other comprehensive income. Here you need to understand revaluation surplus is not an income, that an other comprehensive income. Here you need to understand land is an asset, revaluation surplus we will recognize as an other comprehensive income, that's not an actual realized income. Okay, so we will write the answers here right now. So accrued electricity, what has happened? Expense is increased because debit record in the electricity expense means increasing the expense. So that's an increase. So electricity expense increased. So expense increased means profit decreased. So that's a decreased. Interest income receivable. So credit in the interest income. So that's an income account. So if it income increased, profit will increased. And discount received, income is increased. So profit will be increased. And also there is no effect on income or expense because revaluation surplus in other comprehensive income. So there is no change related to that. So that's the answer for question number 38. So let's do the question number 39. Randaru Sports Club has 100 members. Annual subscription of a member is rupees 2,400. The following information is given. So description as at 31st March 2018 and as at 31st March 2017. So opening balances and closing balances is given. Subscription received in advance, subscription in arrears. So indicate the following of this sports club. The A part is asking subscription income recognized for the year ending 31st March 2018. And the B part is asking total subscription received during the year ending 31st March 2018. to make sure you are not wasting your valuable time here, you need to follow a thorough step-by format to take the answers quickly for this type of questions. Otherwise, if you are thinking very much, you will lose the time here. So the format is the two things they are asking: subscription income and total subscription received. So you remember the formula like this. So you can start from total subscription received. So total subscription received mean as a cash we have received in the year of 2018, 31st March 2018. So that's the second question, total subscription received during the year. We need to calculate subscription income recognized for the year ending 31st March 2018. That's the A part. We all know income we are recording in an accrual basis. Whether we have received the cash or we don't receive the cash, we need to record that as an income. That's an accrual basis concept. But if we receive the money, if we receive income for future periods, or if we received income for previous periods, we will record in the cash book as received date. It means in the cash basis. So for example, so you are receiving a subscription income in 2018, but that related with 2017, but you will record in the 2018 cash book. In the same example, we can say you are receiving cash in 2018, but that is for the future period of 2019, but still you will record in the cash book of 2018. We need to convert this total subscription received cash balance to subscription income, so accrual basis. So normally from row number first to row number 12 we need to convert. This type of questions, they need to give either total subscription received or total subscription income. In this question they have given subscription income. So how we can calculate this? In the question the examiner mentioned Randaru Sports Club has 100 members. So they have 100 members, and for each members the annual subscription is 2400. So for this particular period of 2018, each member has to pay 2400. So 100 members, so we can calculate easily 100 times by 2400. So 240,000 is an annual income. In some question they will give the total subscription receipt. In some question somehow they will give the subscription income recognized during the period. Now we need to calculate the total subscription received during the year, that we don't know for the moment. You need to look at the current years, 31st March 2018. Don't look at the 31st March 2017 data, it will make you confused. So look at the 31st March 2018 data. So the examiner said subscription received in advance 24,000. So what it means is we have received advance in 2018. So why we need to receive the advance for 2018, and also the date is 31st March 2018. So obviously the advance should be for the next period starting in the next day, 1st April 2018. So the advance as at 31st March 2018 in the year end 24,000 we have received for next years. If we want to convert the total subscription to subscription income, we have received the advance, so that advance we have recorded in our cash book in 2018 because we have received that advance in 31st March 2018. So it is in the cash book of 31st March 2018, and also total subscription received as a cash, it should be there because we have received in 2018. So we need to remove this from the total subscription received. So we need to less subscription received in advance. The amount is 24,000. We need to deduct 24,000. Then look at the next one for 31st March 2018. Subscription in arrears as at 31st March 2018 is 36,000. So what it means by arrears? So arrears means that is related to 31st March 2018. It means our current year period, but still we didn't receive that subscription amount. But anyhow, whether we have received the money or not, the income is income for that period, because we have earned that income. So the subscription in arrears 36,000 related to 2018. We can't find that in the total subscription received as a cash. Because of why? We didn't receive as a cash, because that is arrears. Still we didn't receive in the cash, so it should not be in the total subscription received as cash figure. So we need to add that one to take the subscription income. If we want to calculate the total subscription income 2018, we need to add that one, that is 36,000. Now look at the 31st March 2017. It means the previous year's balances. Now subscription received in advance as at 31st March 2017. It means you need to think in the last year's perspective. So in the last years we have received the subscription received in advance as at 31st March 2017. So obviously in the next year, 1st April 2018. So that is the period actually that advance is related. We need to recognize this as an income. And also that subscription received in the previous year, so it should be recorded. It already recorded in the previous year cash book. So this total subscription received as a cash we are calculating for current year. It means 2018 period. So that 12,000 we have received for our current year as an advance in the last year, and also that is recorded in the last year's cash book. So we can't find that in the total subscription received in the cash 2018. So we need to add that one. Then subscription in arrears as at 31st March 2017. So 31st March 2018 means the last year's one. In the last years we have arrears of 48,000. It means that is an income for the 31st March 2017, but we didn't receive in the last year's one. So if we didn't receive because of that one, that is in the arrears of 31st March 2017, so we will receive in the 1st April 2018 onwards. So it should be within the total subscription received within our total, it should be within the total subscription received as a cash 2018 figures. So we need to deduct that one. Now we can find the total subscription received as a cash, because we need to work on backwards. So we know total subscription is 240,000, that is 240,000. Then we will add back that 48,000. Then we will remove the 12,000. We will remove 36,000. We will add the 24,000. Then 264,000. So now we can write the answers here. So the subscription income recognized for the year ending 31st March 2018 is 240,000. So how we have calculated is 100 members. For annual subscription for one member is 2,400. So we have times 100 into 2,400. And total subscription received during the 264,000. So here the very good understanding is you need to think very clearly here. So make it as a format. You in the first line total subscription received as a cash, then leave some blank spaces, then subscription income 2018. So you need to go, if the question is saying about the subscription income details, so you need to go from subscription income to find the total subscription received. So in some cases in the question will say the total subscription received during the period. So in that case you need to come from total subscription received to subscription income. These details anyhow the question will provide. So that's the answer for question number 39. Okay, let's look at the question number 40. The following information has been extracted from the profit and loss appropriation account of Anura and Bimal partnership for the year ending 31st March 2018. So 5% interest on capital has been given for Anura and Bimal, and profit share has been made Anura and Bimal. This account has been prepared by a trainee accounts clerk without considering the partnership agreement. However, these amounts have been posted to the partners' current accounts. As per the partnership agreements, profits and losses should be shared between Anura and Bimal in the ratio 3:2 respectively. There is no provision in the agreement as to interest on capital. Write the journal entry to rectify the current account balances of the partners. So what has happened in this question is, there is a accounts trainee, he has made an calculations for partnership current accounts and he has posted to the partnership current accounts. But actually there is an agreement is there. So in fact you need to consider the agreement if it is any agreement. If you don't have any agreement, only we need to think about the partnership act. So here we have an agreement, so we need to follow the rules in the agreement. So now the question is asking, write the journal entry to rectify the current account balances of the partners. So he has made some entries. So if we want to make an actual figures, what are the entries we need to pass? That's the question is asking. We will make a partner's current account, 5% interest on capital. So interest on capital we will record in the partner's current account. So 5,000 for Anura and Bimal 20,000. Then he made a profit share. So profit share also we will record in the partner's current account. Anura 20,000, 10,000 Bimal. Now we will have entries. So actually the flow of the partnership account will be like this. We will start with net profit. From that net profit we will share interest on capital. Interest on capital is only in this question, so interest on capital. And if we have a partner salaries, we will deduct. So there is no partner salaries in this question, so we have only interest on capital. Then we will less profit share. After, the balance should be 0 because we need to share all the things. The profit share for Anura and Bimal is 30,000. For Anura 20,000, Bimal 10,000, so total is 30,000. The profit share. Interest on capital, Anura 5,000, Bimal 20,000, so altogether 25,000. So the net profit should be 25,000 plus 30,000. 55,000 net profit is shared by interest on capital and profit share between Anura and Bimal. Now we will do. So now we are going to consider the partnership agreement. So as per partnership agreement, we need to share the profit in the ratio of 3:2 respectively. And also there is no provision in the agreement as to interest on capital. So according to the agreement, if we don't have any interest on capital, we can't give interest to capital. If we don't have agreement only, we need to consider the interest on capital for 5%. By now we can't give any interest on capital according to the partnership agreement. So we will look at the separate session for partnership. Now we will do the question. Now we know we have a net profit of 55,000 and we don't have any interest on capital. The interest on capital is 0. We can't give anything. So for the whole 55,000 we need to share between Anura and Bimal as a profit share. The ratio is 3:2. For Anura, this 50,000 we will divide by 5 and times by 3. It will be 33,000. For Bimal, the remaining part, that is 22,000. Accordingly, the trainee's record of the partner's current account, we have a balance of 25,000 for Anura, 30,000 for Bimal. But we need a balance of 33,000 and 22,000 for Bimal. Actually, we need to have a balance of Anura is 33,000. So we need to increase. So increase means we need to credit record in Anura current account. We should arrive at 33,000, but now we have 25,000. So we need to post 8,000 in the trainee's current account to make it as 33,000. Then if you consider the Bimal one, Bimal In trainees current account 30,000, but actually it should be 22,000. So we need to remove that 8,000 from Bimal account. So reducing means debit record in Bimal current account by 8,000. So how we can calculate this? We have 30,000, we need to come for 22,000, so we need to reduce 8,000. So debit record Bimal current account 8,000 and Anura current account is 8,000. So we will write the answer here. Current account Bimal, current account Anura 8,000. So that's the answer for question number 40. Okay, let's look at the question number 41. Shanta and Yashit are partners in a business. They share profits and losses in the ratio 3:2 respectively. On 1st April 2017, Dayan was admitted as a partner and capital balances of Shanta and Yasit on this date were rupees 1 million and rupees 750,000 respectively. The new profit and loss sharing ratio among Shanta, Yasit and Dayan is 2:1 respectively. On this date, the goodwill of the partnership was estimated as rupees 3 million. Further, it was decided not to maintain a goodwill account but to adjust it through the partners' capital accounts. The capital balances of Shanta and Yasit after adjusting for the goodwill. So normally in your syllabus, the goodwill should be adjusted through capital accounts. There is no separate goodwill account. The question is the capital balances of Shanta and Yasit after adjusting for the goodwill. So we have given with opening balances of capital accounts. Shanta and Yasit. Shanta has 1 million. Yasit has 750,000. For Dayan, 0. There is no balance of opening balance. Okay. Then they have given with the information of Shanta has taken 3, Yasit has taken 2. A new profit share ratio that is 2 to 1. The total share is 5, here also 5. And the goodwill amount is 3 million. Further, it was decided not to maintain a goodwill account but to adjust through the partners' capital accounts. You need to understand the goodwill 3 million, it belongs to Shanta and Yasit because Dayan is a new person. So goodwill means the employee reputation, the brand name, so a kind of things because they did a business for a long time, so they made a reputation with their customers, with their employees. So that's called goodwill. So this goodwill owned by Shanta and Yasit, there is no portion for Dayan. This is owned by Shanta and Yasit. Then now Dayan is coming. And here you can understand what has happened in the profit share ratio between old and new. The old ratio, so 3 shares is taken by Shanta and Yasit has taken 2 shares. Now what has happened in the new shares, Shanta has given away his 1 share and he agreed to take 2 shares. But Yasit, there is no change. He doesn't agree to give away. So Shanta's 1 share is now given to Dayan. So this is happening in the old ratio to new ratio. Increase the capital account by old profit share ratio. Increase the capital account by old profit share ratio because old partners owned goodwill. Then decrease the capital account by new profit share ratio. You need to adjust the goodwill. So you need to add by old ratio. So what is the old ratio? We have a goodwill of 3 million. Okay. We have a goodwill of 3 million.
we have a goodwill of 3 million. That 5 shares, the total share is 5. For Shanta, according to old ratio, we have to give 3 shares, so 1.8 million. The same, we have 3 million, total share is 5 and 1.2 million. So here 0 to Dayan according to old ratio, then less by new ratio. So 3 million. Now also the total profit share is 5, but this time we are going to give only then here also 3 million divided by 5 shares, and we will give the same shares, so the amount is not going to change. Here also we need to less that one. According to new shares, here you can see the old ratio we need to give Shanta 1.8 million, but according to new ratio 1.2 million, so that balance 600,000 goes to Dayan. We can prove that one. So here we have 3 million, then 5 shares, we will give a 1 share to Dayan, so that 600,000 is here. So that also we need to less, because Dayan has to take that money to the partnership, because he doesn't have any ownership to the goodwill, so he has to take it as a capital or in a form of cash. Because of that one, we are reducing from Dayan capital account. Now you can see the balance. So Shanta balance is 1.6 million and Yasid balance is 750,000. So if they ask Dayan how much he has to take as a goodwill, 600,000. So now we can write the answer here. So he has to take 1.6 million, Shanta, and Yasid capital balance after adjusting the goodwill will be 750,000. So here students, you need to remember only one thing. When it comes to goodwill adjustment, always in your syllabus they will ask to adjust the goodwill through the capital accounts. So you need to remember these two lines. The first line is, we need to increase the capital account by sharing the profit by old ratio, old partners account, and we need to decrease the capital account by new profit share ratio. Why we are increasing the capital account by old profit share ratio? Because those goodwill earned by the old partners, so we need to give that one. And new partners, so now we have a new agreement, so we need to reduce that one. This is the answer for question number 41. So let's discuss the question number 42. State whether the following statements are true or false. So T for true, false, F according to Sri Lanka accounting standards. So the examiner is asking not the deep understanding of the standard here. He is checking whether you at least read the standards on the teacher's guide, or you at least understand the concept in your study notes. So that's the basic expectation from the examiner from this type of question. We have statement and we need to write T or F to mention whether that statement is true or false according to Sri Lanka accounting standards. The A, he is talking about provisions, and B, he is talking about contingent liabilities. In C, he is talking about inventory, and D, he is talking about changes in accounting estimates. 3 standards he is talking here. We will have a separate session for every standard. So for the moment of understanding and doing the question, we will have some part related with this question, the theories. Then we will come back to do the questions here. First, you need to understand what it means by provisions. So provision is a liability of uncertain timing or amount. So that is the definition has given for provisions. So you need to understand and you need to remember this when you heard the word provisions.
So provisions mean it's a liability. So what it means by liability? If we define something as a liability, it should be a present obligation from past events, and the liability should be measured reliably. So if we met that liability, and also that liability, it means that present obligation is uncertain in the timing or amount. We can't surely say so this liability will happen in this particular time and this particular amount, but it's a present obligation, that's called provisions. Then what it means by contingent liability? So contingent liabilities are not present obligation, that's a possible obligation. It might happen or it might not happen, that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events wholly within the control of the entity. Then you need to understand provisions we will recognize because of why? Because we have a present obligation. There is a probable outflow to the economic resources. But here we have only the possible obligation. So contingent liabilities are not recognized as a liability as provisions. So provisions we are recognizing as a liabilities, but contingent liabilities are not recognized as a liability in financial statement. Only we will disclose the details. The same for contingent assets also. Then changes in accounting estimate. So what it means by changes in accounting estimate means it's an adjustment of the carrying amount of an asset or liability. So here the asset mean it might be receivables, it might be inventory. So there should be an adjustment in the carrying amount. It means the end of the balance we are carrying, there should be some changes. So we are calling that as an accounting estimate. That results from the assessment of the present status and expected future benefits and obligations. For examples of accounting estimates, the changes in accounting estimates, there are three types of changes. If the change affects only the period in which the change occurred, then adjust the profit or loss of the period. It means impairment loss on trade receivables. In simple terms, if you have a bad debt, you have estimated, okay, out of my 100,000 receivables, pretty sure I can't collect 10,000 of the receivables. So there is an estimate on your receivable asset. So there is a change in your carrying amount. We are calling as a technical term impairment loss. It's like a bad debt. That's only the period will affect. Then we need to change the period. So only the period in which the change occurred. So we need to adjust the profit or loss of the period. Okay. Then allowance for expected loss on trade receivables also. Sometime we can have a doubtful debt also. We will make provisions or allowance. So that also there is, because of what we are doing when we are presenting the receivables account in the balance sheet, we will reduce the closing balance of the allowances from trade receivables and net will be we will show in the balance sheet. Because of why in the that's an accounting estimate. If there is any change, we need to adjust the particular year profit or loss of the period. And if the change affects both the period in which the changes occurred and the future periods. Now the current period and future periods. For example, if we have a changes in depreciation values due to the changes in useful economic life of property, plant and equipment. If there is an increase in the useful life of the asset, then we will have a change in our depreciation amount because we have a new value of amount. So because of that one, our current accounting period after the change, let's assume the useful life of an asset is increased in the June 2018. Then from that June 2018 to 31st March 2018, for that current period also it will affect the figures of depreciation, and also upcoming future periods also we need to change. So both the period we need to adjust. So that is an accounting estimate change. And if the change affects assets, liabilities or equity, Then adjust the related period assets, liabilities, equities and their fair values. So this is an accounting estimate change. Then what it means by retrospective? So retrospective means implementation new accounting policies. So accounting policies, changes in accounting policies are not for your A-level syllabus. Only changes in accounting estimate question will be for your in your new syllabus. For transactions even to other circumstances as if it had been implemented. In other words, retrospective will affect presentation of financial statements for previous periods. But in accounting estimates, we don't have any effect of previous period. It might be current period or it might be current period and future periods. We don't have any retrospective. It means we are not going to adjust the previous year's figures. But in accounting policies, it might be. So now, provisions are possible obligation with uncertain timing or amount. So, possible obligation with uncertain timing or amount. We are not calling as a possible obligations. Provisions are liabilities with uncertain timing or amount. So liabilities means we have a present obligation, not possible obligation. If the word present obligation is there, the statement is true. Because of we have possible obligations, we can't say that's a true. So that's a false statement because it should be present obligation or liability with uncertain timing or amount. And B, contingent liabilities are disclosed in the notes to the finance statements. Yes, we have contingent liabilities. We can only disclose to the notes to the finance statements. We are not recognizing as a liability in the balance sheet or we are not recognizing any expenses related to contingent liabilities. We are only disclosing. So that's a true. And year-end inventory is valued at cost and net realizable value, whichever is low. So that is in LKS2. You need to report your inventory either in lower of cost or net realizable value. So that's a true statement. And changes in accounting estimates are accounted for retrospectively. No, the retrospectively term is related with the accounting policies and also accounting estimates we can change the current period or current period with future periods. We are not doing anything retrospectively there. So that's a false statement. So this is the answer for question number 42. Let's discuss the question number 43. So state as per LKS 1 presentation of finance statements the components of finance statements in which the following items are presented. So if you have a doubt what it means by component of finance statements and elements of finance statements, watch the session number 1. So we have discussed thoroughly the component of finance statements and elements of finance statements. In the nutshell, components of finance statements means different type of statements and elements of finance statements means the 5 types of the elements of finance statements means assets, liabilities, equity, expenses and income. So here the component of finance statements means the examiner is expecting to you need to have a knowledge of difference between component of financial statements and elements of finance statements, and also students sometimes they will confuse with the terms component and elements and they can pick the wrong one. So here this is a cost of sales. So the cost of sales is related with income statement. Here you need to say the full name of the every statements, correct name of the statements. So here we will have cost of sales in the income statements. The exact name is statement of profit or loss and other comprehensive income. Here if you are trying to write here cost of sales, that's an expense. So the category is expense, that's an elements of financial statements. That's not the thing the examiner is asking because the question is component of financial statements. And retained earnings. So retained earnings we can see in 2 places. The first one is statement of financial position, or you can write statement of changes in equity. Both you can get marks. So income tax paid we will use in the statement of cash flows, and Trade payables we will see in the statement of financial position. So that's the answer for question number 43. So let's look at the question number 44. State two items each that are reported as cash outflows from investing activities and financing activities as per LKS 7 statement of cash flows. So investing activities and financing activities. So we have discussed clearly in about LKS 7 statement of cash flows, direct method and also indirect methods in the theory session playlist. So you can watch that one for further understanding. Here, so what it means by investing activities, we have invested for getting outcome. Financing activities means we need some finance for our businesses, how we can collect that finance. So investing activities normally, so if you purchase of property, plant and equipment, that will come under the investment activities. That's a cash outflow. And also purchase of other non-current assets other than property, plant and equipment. If you purchase any other non-current assets, that also an investment activity, net cash outflow. Then we can say if any loan provided to employees, also that's an investment because we will receive an interest income from that loan. So that also investing activities. So cash outflow. And other than that, cash inflows are received the cash from disposal of property, plant and equipment. If we receive any cash from selling other non-current assets, and if we receive dividend anything because we have invested in shares, so we have received dividend, so those also dividend received, and interest received, rent received. So those kind of stuffs are investing activities. So for this question they are asking specifically the outflows. For outflows we can say purchase of property, plant and equipment. We can say purchase of other non-current assets also, but we will say purchase of shares or debentures, that also investment. If you invest in shares or if you invest in debentures, that also investing activities, cash outflow. Then financing activities. Financing activities, so if you obtain loan and if you collect the finance from share issue and also any dividend paid, distribution among the shareholders, the dividends, interim dividends, any repayment of the loan and any loan installment paid, lease installments paid. So these are the kind of financing activities. We can say interim dividends paid, any interest payments. For examples, you can visit the cash flow direct method. There are a lot of examples. So that's the question number 44. Let's do the question number 45. So inventory turnover ratio and current ratio for retail business were 10 times and 2:1 respectively, but subsequently it was found that the following transactions had been omitted from the books. When these transactions are considered, state whether the inventory turnover ratio and current ratio will increase, decrease or no change. So there are two transactions, sale of goods costing rupees 500,000 for rupees 800,000 on credit, and B, purchase of goods costing rupees 250,000 on credit. So this type of questions, so 10 times and 2:1. Okay, so inventory turnover ratio. So inventory turnover ratio, how can we calculate is trade receivables divided by average inventory. Then current ratio, current assets divided by current liabilities. Now in this question they have said already it's in 10 times inventory turnover ratio and 2:1 current ratio. It means they can cover their current liabilities by 2 times, and 10 times the inventory is converting as a sale. So for this 10 time we will have a imaginary figures. So like we will take 10 million divide by 1 million, then you can have a 10 times. Okay, for this 200,000 divided by 100,000. then you can have a 2 to 1. So always students, I am advising so to have a imaginary figures. So the first scenario, sale of goods costing rupees 500,000 for rupees 800,000 on credit. So first record, we will think in the journal entry form. So what will happen? So in the sale of goods costing rupees 500,000 for rupees 800,000 on credit, there are two transactions. The first one is sale. There is a credit sale. For this credit sale, the double entry will be, we made a sale of rupees 800,000. So trade receivable of 800,000. And the credit entry will be revenue. Then also we have cost of goods sold also. So we need to debit, so inventory turnover ratio, cost of sales divided by average inventory. Debit record cost of sales, we need to credit to our inventory because we are making sales, so the inventory will be reducing and that amount we are going to debit to the cost of sales. So these two transactions happen, transaction A. And in the transaction B, purchase of goods costing rupees 250,000. So that's a credit purchase. So here the double entry is debit the inventory. We are purchasing goods costing rupees 250,000. And also we will credit the creditors because we need to pay. Okay. Now we will look at what will happen to our inventory turnover ratios and current ratio because of these two transactions. Okay. Now we already have a, for an example, we have taken the figures. So we already have a 10 million of cost of sales. So now due to this one, we already have a 10 million of cost of sales. Then again, because of the transactions A, so trade receivables revenue, so that is, these figures are not related with the inventory turnover ratio, but cost of sales and inventory, that is related with inventory turnover ratio. So the cost of sales will be increased by rupees 500,000. So already we have a 10 million. Now our cost of sales will be increased by, our average inventory is 1 million. So it's going to reduce by 500,000. So the inventory turnover ratio is now 21. And what's the impact will be given to the current ratio? We have a 200,000 assets. Then we are going to increase our assets by 800,000 for trade receivables. So we have 200,000 assets. Then we will increase the asset by 800,000 for trade receivables. Then again there is a reduction of 500,000 of inventory. So current asset figure is that one. And is there any change in the current liabilities? There is no change, so same figures will be there. So if we calculate that one, it will be 5. So the inventory turnover ratio, it becomes a 21 and the current ratio become 21 to 51. So both are increased. So we can say for the answer I. and I for both. Then again, okay, then the credit purchase, the second one. Now we have 10 million. There is no change in that 10 million because there is no entry related with cost of sales, but average inventory will be increased by 250,000. So with this 1 million, 250,000. So now 10 to 8, it's decreased. So inventory turnover ratio is decreased. What will happen to our current assets? Current assets, we have already 200,000. Now the inventory is increasing 250,000. So 450,000. Also the current liability also increasing by 250,000. Then we can calculate now. So now what has happened is 1.28 from 21 to 1.281. So that also decreased. So that's the answer for question number 46. So here the trick is always have imaginary figures for the inventory turnover. Let's look at the question number 46. The following information was extracted from the financial statements of Ananda PLC for the year ending 31st March 2018. So we have given with gross profit, cost of sales, other income, operating and financing expenses, other comprehensive income. The income tax rate of the company is 20% on profit before tax. The following ratios of the company for the year ending 31st March 2018. Gross profit ratio and net profit ratio. Okay. So we have been given with gross profit and also cost of sales. So if we have gross profit and cost of sales, we can easily find the revenue figure. So gross profit is 4,800. Cost of sales is 7,200. With this 4,800, if we add 7,200, we should get the gross profit. So the revenue is 12,000. Then we have other income. So other income is 1,500. Operating and financing expenses 4,500. Then other comprehensive income. So profit before tax we can call as PVT. Other operating and finance expense, that's a minus fee. So from gross profit 4,800, if we add other income 1,500 and less 4,500 operating and finance expense, 1,800 will be the profit before tax. Then income tax. The income tax rate of the company is 20% on profit before tax. So 1,800 times by 20%. So it will be 360. So we have a net profit 1,440. Then we have other comprehensive income. So other comprehensive income is 1,500. Total comprehensive income is now 1,500 plus this 1,400. Now we need the gross profit ratio. So gross profit ratio is calculated by gross profit revenue and times by 300 times by 100% times by 100. So the gross profit is 4,800 and the revenue is 12,000. So 40%. So that's the answer for gross profit ratio. Okay. Then the question is asking net profit ratio.
net profit divided by revenue and times by 100. So net profit is 1440 and the revenue is 12,000. A company is planning to manufacture a type of toy. The budgeted information related to this product for a given period is as follows. So we have given with direct material cost per unit, direct labor cost per unit, total direct cost per unit, and direct labor rate also rupees 200 per hour. Production overhead absorption rate is rupees 300 per direct labor hour. Non-production overhead is 20% of the total cost. So indicate the following: budgeted production overheads per unit and budgeted production cost per unit, budgeted total overheads per unit. Okay, so let's do the question. So we have given with direct material. So direct material cost per unit. So every details is for unit. So direct material cost per unit is 2300. Direct labor cost is 1000. How this direct labor cost can come? So 1000 means if we want to produce a 1 unit, it will cost 1000 rupees. So this is a direct labor, so the actual persons will work in the hourly basis. So also in the question, the direct labor rate is rupees 200 per hour. So for 1 hour the labor will get paid for 200. And also we don't know the budgeted hours details here, but we can find it because 1000 is a unit cost per unit, and also 200 it's the rupees, so it should be 5 hours to get that 1000. 200 times 5, so it should be 5 hours. Our total direct cost per unit, so total direct cost per unit will be 3300. Production overheads absorption rates, non-production overheads. So production overhead absorption rate is rupees 300 per direct labor hour. So we need to find production overhead per unit. So how can we calculate this? We need the overhead absorption rate, rupees 300 per direct labor hour, rupees 300 per direct labor hour. So we need 5 hours to produce our 1 unit. So 300 into 5 units, 300 into 5 hours, so it will be 1500. So budgeted production overheads per unit, the answer is 1500. So that's the question number A. Budgeted production cost per unit, then they are saying non-production overhead is 20% of the total cost. So now what it means by total cost? So total cost is equal to production overhead plus production cost plus non-production costs. That's called total cost. Now we know the production cost now. 3300 is the total direct cost per unit, and production overhead per unit is 1500. So 4800 is the total production cost per unit. So that's a production cost per unit, the second answer. Then the C, budgeted total overheads per unit. So what it means by total overheads? So total overheads means we need to know production overheads plus non-production overheads. So production overheads means the factory cost, the machinery's maintenance cost. So those are the production overheads. To produce the goods, what are the costs we are incurring is production overheads. Non-production overheads is not in factory. It's like admin expenses, marketing expenses, those kind of expenses we are calling in the manufacturing environment as a non-production overheads. So in the question they have said non-production overhead is 20% of the total cost. Now non-production overheads, we need to find this one, non-production costs. So they are saying 20% of the total cost. So if we take this total cost as 100, the non-production cost should be 20. So the 80 should be the production cost. We know the total cost per unit. Now we know the total
production cost per unit, that is 80. So this 4800, it should be equal to this 80% because that is the production cost per unit, total production cost per unit. So it represents the 80%. Now we need to find the 20% of, that is non-production cost. So we need to times by 20. Then the non-production cost is 1200. The question is now asking budgeted total overheads per unit. Budgeted total overheads means, according to our equation, the total overheads. So production overhead is 1500, non-production overhead is 1200, so 2700 is the budgeted total overheads. That's the answer for C, 2700. A company manufactures a single product beta. The following information relates to a raw material used in its production. Annual consumptions of material 10,000 units, ordering cost is 400 per order, and holding cost is rupees 200 per unit. So indicate the following: the economic order quantity of this raw material and number of orders to be placed per annum based on the EOQ. This is a basic EOQ questions. So here you need to know, students need to know the EOQ equation, economic order quantity, that is square root of, so that's a square root of 2d CH. It means, so the D is equal to demand, that's an annual demand or consumption, and CO is cost of ordering, CH is cost of holding a unit. Now in this question, the annual consumption of the material is 10,000 units. So 2 into the annual demand is 10,000 units, cost per order is 400, then 200 per unit holding cost. That's an EOQ, 200 units. And question number B, number of orders to be placed per annum based on the EOQ. So number of orders, we have the annual demand for 10,000 units. We will order at a time 200 units. So if we want to fulfill our annual demand of 10,000 units, by every order 200 units, we need to order for 50 orders. That's the answer for question number 48. Let's do the question number 49. A company produces a single product and sells at rupees 60 per unit. If the company sells 16,000 units, the loss per unit is rupees 10, and if it sells 40,000 units, the profit per unit is rupees 8. Indicate the following: total fixed cost, contribution per unit, and break-even point. If the examiner is giving 2 units and 2 activities or 2 cost or 2 profit, you need to remember, you need to use the high-low method to calculate the answers. So we have discussed the high-low method. So how to do that high-low method in the session number 3. So you can watch that for the further details. Total fixed cost. So we need to calculate the total fixed cost. 60 per unit. So selling price is given is 60 per unit. If the company sells 16,000 units, the loss per unit is rupees 10. Profit or loss. For 16,000 units, profit or loss per unit. The loss per unit is 10. We will have a 10 of loss. And if it sells 40,000 units, we will have a profit per unit is 8. So that's all the information they have given. Within this information, so the selling price is 60. So when 16,000, we need to calculate the total cost per unit. How can we calculate that one? Our selling price is 60, and also we have a loss of 10, so we can calculate our cost here. The cost should be 70 per unit. And when we produce 40,000 units, same methodology, selling price is not going to change, that is 60. We don't know the cost, but we know we have a profit are positive figures. So the profit amount is 8 per unit. 52 will be the, now you can find the total cost, not for the unit, total cost. So how can you find this? 60,000 units if we produce, we will have a 70 per unit cost. So this is the amount of total cost, 1,120,000. And if we produce 40,000 units, we will have a cost per unit is 52. So this is the amount of total cost. Now we can use the high-low method to get the total fixed cost. High-low method we have discussed fully in the previous session question. You can watch that one. So high-low method is saying take the highest cost. Highest cost is for the 40,000 units. And we need to remove that one, the lowest cost. From that highest units, remove this 16,000. You can get a variable cost per unit. You can calculate the variable cost per unit in high-low method. So how we have calculated this high-low method is, in the top part 960,000 we need to take the highest cost, that is 2,080,000, and we need to deduct the 1,120,000, so that is 960,000. This 24,000 we have got is highest unit is 40,000, and we have taken away the 16,000 lowest units, that is 24,000. So then we can get the 40 variable cost per units according to high-low method. Now we can calculate the fixed cost. So how can we calculate is, now we know total variable cost when units are 40,000, 40 for 1 unit of variable cost, and if we produce 40,000 units, it will be 1.6 million. And also total cost is equal to fixed cost plus variable cost. Now we know the total cost of 40,000 units, that is here 2,080,000. From that one we know the variable cost also here, 480,000 will be the fixed cost. Okay, then contribution per unit. So contribution per unit, so what's the formula for contribution per unit? Selling price take away variable cost per unit. Now we know the selling price is 60 and also the variable cost is 40, so 20 will be the contribution per unit. The next question is break even point in units. So BEP in units, the formula is fixed cost divided by contribution per unit. We have calculated the fixed cost 480,000, contribution unit is 20, so 24,000 will be the break even point units, 24,000 units. So that's the answer for question number 49. Let's do the question number 50. A company has decided to air condition its factory to improve employees' performance. The cost of the air conditioner is rupees 1.5 million. It has a 5-year useful life with no residual value. It is estimated that annual income will increase by rupees 600,000 due to the increase of employee performance. Further, an additional maintenance expense of rupees 240,000 per annum will be incurred for the air conditioner. The company depreciates its property, plant and equipment on the straight line method. So indicate the following for the proposed project. So estimated net cash flow of year 1 and expected annual net profit. So year 0, what we are doing is, so we are going to invest in an air condition in its factory, air conditioning in the factory. So the cost of the air conditioner will be 1.5 million. So that is in year 0 we have a outflow of 1.5 million. It has a 5-year useful life with no residual value. There is no residual value. It's estimated that annual income will increase by rupees 600,000. Annual income by 600,000. That's a cash inflow. So the year 1 also we can get the annual income due to the increase of employee performance. Further, an additional maintenance expense of rupees 240,000 per annum will be incurred for the air conditioner. So maintenance expense, that is 240,000 cash outflow. The company depreciates its property, plant and equipment on the straight line method. So depreciation is not a cash flow or cash outflow. The first question, estimated net cash flow of year 1. So in the year 1 we are estimating 600,000 as a cash inflow and incurring 240,000 cash outflow. So the answer is 360,000. That is the estimated net cash flow of year 1. Then expected annual net profit. So this 360,000, now the useful life is 5 years and the cost is 1.5 million and there is no residual value. It means 300,000 will be the depreciation for every year. So if we want to convert our net cash flow to profit, we need to remove this 300,000, because if we consider as a profit, we need to remove all expenses. So the maintenance also one of the expense, and also depreciation also expense, we need to remove that one also, 300,000. So 60,000 will be the expected annual net profit. So that's the answer for question number 50.
Students, we launched our Telegram group for students. There we will share the study materials and sessions. Also students can ask questions directly to me and with our digital accounting team also. And next important one is we are requesting our students and our well-wishers to support by sharing our video lessons, and if you think it will helpful to get success in the upcoming and also other exams of the students. And also we have arranged special individual student class programs for students who actually in more need. For further details you can join our Telegram group and contact the admin or me there, and we will share the further information about this online individual program.